So this is part 16 of this multi-part video series. Few points I wanted to cover in this video. First is let us do a quick recap of whatever we have learned till now. It's like a summary, putting it all together. That's number one. Number two, few doubts some of my subscribers have asked, which I wanted to cover in this video. One of them was regarding the technical criteria of William O'Neill, what we see on the chart. So I will talk about that as well. I will explain to you the question and then I will give you the answer. Just the 2 points I wanted to cover in this video, but get this process right. Okay. So a quick summary, you already know that the first step in our positional trading system is filtering. So out of 5,000 stocks, you come down to, let's say, 100. That's called filtering. So you get those 100 stocks. Then you do from here to here, you do what is called as shortlisting. You do shortlisting based on technical criteria, not based on fundamental criteria. If a stock is fundamentally strong, but technically it is weak, it doesn't make sense to take that trade. So shortlisting needs to be done based on the technical criteria, which you already know, which we have discussed. So after you get the 100 stocks, you do the shortlisting. And then after here, it goes into stock selection. This is about stock selection. Okay. So those 5 stocks out of 100, you shortlisted 5 stocks. Those 5 stocks will go through this rigorous selection process. Out of 5, maybe you select 1 or 2. Okay. So remember these terms: filtering, shortlisting, stock selection. Then stock selection is still fundamental. Okay. Liquidity, comparative, technical, fundamental. Till here it is stock selection. Then market is for position sizing. Remember, market is not for stock selection. So first you shortlist stocks. First you filter stocks. Out of 5,000, you come to 100. Then out of those 100 stocks, you shortlist 5. Out of those 5, you run them through this system, stock selection system. Out of 5, you get 1 or 2. And then after looking at the market, you will determine the position size on those 1 or 2 stocks. Filtering, shortlisting, stock selection, position sizing. Okay. Then when the week begins and the price enters the blue shaded area, then you have to execute the trade. Okay. After you have executed the trade, the first thing you have to do is to set a very hard stop loss, okay, which is 8%. So that is called as risk management. And then you go into trade management. So when the price starts to move from the blue shaded area to the green shaded area, how do you manage the trade in that run? We hope that the price reaches the green zone, but from the time that it moves out of the blue zone and starts heading towards the green zone, a lot of things can happen in between. So, for example, the market conditions could change, or the company might announce the fundamentals which turn out to be weak, things like that. So, that might prompt you to uh, manage the trade. How do you manage the trade? When you buy a stock and it goes up, you basically have 5 options. Either you do nothing, or you sell everything, or you sell half, or you sell less than half, or you sell more than half, right? These are the 5 options you have, apart from moving the stop loss up, of course. But that is a part of trade management. You have to get this system right. Now, you tell me, if you follow this kind of a process for your entire trading life, let's say the next 30, 40 years of your trading career, don't you think this will help you? Don't you think this is a very structured, broad macro approach to trading and investing in stocks or doing positional trading? So you start with filtering, then do shortlisting, then do stock selection, then do position sizing, then execute the trade, manage the risk and manage the trade. As simple as that. Just one sentence has summarized the whole trading system. You look at any US investing champion, you look at any trader, professional trader, more or less they are following this system. Okay, this is applicable on weekly time frame, this is applicable on the daily time frame, this is applicable for swing, this is applicable for positional trading. Okay, so get this orange trading system correctly. There is no need to automate all of this. Okay, a lot of my students, subscribers have tried to automate this. No need to do that. If you're doing it fine, there is no problem with that, but there is no need to do it. That's what I'm saying. If you understand the basic concept, this is how you think strategically about a particular stock. Regarding a question that one of my students was asking, let me explain to you the question first. So let's go to MarketSmith. I go to product support. Scroll down. Yeah, have a look at this. So there is a blue shaded area, which is the pivot buy range. There is a green shaded area that is the selling range, partial selling range, and the red shaded area, which is the stop loss range. So sometimes what happens is we have the green dotted line, we have the pattern that is drawn. However, these three areas are not available on the MarketSmith chart. Now, from what I have understood about MarketSmith and the charting, these shaded areas appear only when the current price is plus or minus 5% from the pivot point. Okay. Oh, sorry. I would say if the price is within 5% of the pivot point, that is when these shaded areas begin to show up in the MarketSmith chart. That is what I have understood. Okay. And even if they are not there, you can draw it, right? So, for example, if the current price is like 15% below the pivot point, but still above the 10-week simple moving average, you could still draw the buy range, selling range, and the stop loss range, which I've already discussed with you, right? So basically, we are looking for six things: these three shaded areas, plus the pivot point, plus the pattern, plus the price should be between the pivot point and the 10-week simple moving average. That's it. That's all we need. Okay. If the shaded areas are not there, then you draw it, right? So that was the question, that if the shaded area is not showing, then should we reject the stock? No, you should not reject the stock. Okay, because this is a positional trade. The fact that you have shortlisted or selected the stock means that the stock has gone through a very rigorous filtering process, right? Just like, olive oil is made from olives. It's like crushed, filtered, and things like that. So actually, olive oil is not a oil. It's a fruit juice. The olives are crushed to prepare that oil. So it's basically fruit juice. So it's squeezed, and lot of processing has been done on that. Similarly, in the stock market, we are doing filtering, shortlisting, uh, stock selection. After that, we are arriving at a particular stock. So it's not some random stock that we are selecting. So even if those three shaded areas are not there, you yourself can put that shaded area there for a proper setup on your weekly chart layout. Okay. So this is what I wanted to discuss with you. I did a quick recap. This series will continue. We will look at uh, weekly time frame charts. Now we cannot go back and look at the past data. MarketSmith does not provide past data, at least the comparatives. But I will do my best to convey the key learnings. Okay, just I will not show you an example just for the sake of showing an example. There will be a key learning from that, from each of the videos that will come in this multi-part video series. I still don't know how long this series will continue, but this is a nice discussion that is going on. It is almost like a course, right? Which it's almost like a video course. But I hope all of you are liking this series as much as I am enjoying making this series, right? I primarily am a daily time frame chart trader, but occasionally I do take a trade on a weekly time frame chart if everything looks compelling. If everything is in my favor, why not take the trade on the weekly? Sometimes I do that, but on a daily time frame chart, you get a more precise buy point. Okay, I will see you in part number 17. Thank you.